Welcome to XM.com. It's Friday, December 9th. You're watching the Daily Market Comment by Haralabos Pisuros. I'm Cristina Marujos. The US dollar continued trading lower on Thursday and during the Asian session Friday, underperforming all other major currencies. The incentive for more dollar selling was perhaps given by the US jobless claims data. Although the number of people filing new claims for benefits increased slightly, continuing claims rose to a 10-month high in late November, adding to speculation that the labor market may loosen further in coming months despite last week's employment report suggesting that it is still faring well. The next big tests for the US dollar may be next week's CPI numbers for November on Tuesday and the FOMC decision on Wednesday. But today, traders may pay some extra attention to the PPI data. Expectations are for a decent slowdown. Combined with another slide in the University of Michigan one-year inflation expectations, that could add more credence to investors' view of nearly 2 quarter-point rate cuts by the end of next year, and thereby drive the US dollar even lower. Intensifying fears of a global recession at the turn of the year could result in some safe haven inflows for the greenback, but with market participants betting on lower rates towards the end of the year, the yielding dollar may pass the safe haven torch back to the yen and gold. That's why its outlook may be best described as neutral for now, given that any potential strength in coming weeks could just prove to be a short-lived rebound before a new leg south. The S&P 500 snapped a 5-day losing streak after the rise in the weekly jobless claims, suggesting that bad news is still good news for stocks. That said, weak data cannot work in favor of equities forever. Further deterioration in the U.S. outlook could break that inverse correlation, as a damaged economy is far from a positive development for the stock market. Wall Street investors will not have to worry only about the performance of the U.S. economy, but the global one as well. This adds to the narrative that any rebounds in stock indices are likely to stay limited. Oil shrugged off the closure of a major pipeline transferring the black liquid from Canada to the United States. Despite China beginning to ease its COVID-related restrictions, investors seem convinced that demand may deteriorate further in coming months. This was a Daily Market Comment here at XM.com. Have a great weekend.